Andrew's first idea is Canadian apartment REIT. People always need somewhere to live.
Yeah, exactly. And this kind of sounds counterintuitive when we start talking about the real estate market and interest rates going up. And of course, we've seen some very aggressive rate hikes by the Bank of Canada. But if you kind of flip it around, Andy, we're already seeing what I would say is a pretty significant cooling off in the housing market in Canada. Home prices down in some parts of the country from March, 10 to 20%. Those are hefty declines. And unfortunately, there's going to be a contingent of the population that came into the housing market late, paid, prices that were well above probably where they should have been paying, and now have a lot of more interest-bearing costs associated with that. So we do think you're going to see some parts of the population coming out of housing. And of course, to your point, Andy, quite correctly put, you have to live somewhere. So I think the demand for rental properties goes up in this environment, which is why we like Canadian Apartment REIT. We started adding to this position about a month and a half ago, 2 months ago, and are continuing to do that as we speak.
That's interesting. Yeah. Why are they down? I didn't know that. A drop of more than 20% in cap REIT over the past year. I didn't know it was down so much.
Yeah, and we've talked about this for several months now. What we've seen in the economy, what we've seen in the markets is a compression of cycles that we've never really dealt with before. So we've talked about, the fact that we could talk bond yields into a frenzy in the second quarter without the central banks actually doing anything aggressive. Of course, they followed up with that. But we've seen the impact of that as we came into July in terms of the housing data. And now that we have, the validation, if you want to call it that, by central banks in terms of where they're setting rates, that's only going to reinforce this high cost environment for a lot of people that came into the markets late. It may be an environment that they can't stay in unless they see reprieve somewhere else, whether it's fuel prices or anything else. So, I do think you are going to see a shift at the margin. And I want to stress that, Andy, we're not talking about a wholesale correction in Canada's housing market and people losing their homes, or that we're looking at a U.S. situation from back in 2006, 2007. But I do think at the margin, you do see that pickup in demand for rentals.
Okay, you've touched on this theme. Teck Resources is one of the mining stocks you like the look of.
Yeah, absolutely. Now, we've had Teck in the portfolio for quite a while, Andy, and back in the second quarter, we cut our positions in Teck. We didn't come out of Teck, but we came out of Teck just simply because we thought the valuations were not sustainable in an environment where we probably were going to see economic activity cooling off, global demand easing, and commodity prices falling. And to be quite honest, Andy, we were shocked as well as we came into the summer, the extent to which we saw commodity prices pulled back and how this rhetoric of imminent recession kind of developed in the markets, which is now kind of eased back. But what it did do, it provided some very good opportunities in this space. So what we're doing now is basically re-adding back to Teck what we took out of Teck, because we do think the short to medium term trajectory for the stock is good.
Okay, and then finally, Methanex. I've heard in the past that this methanol prices tend to track oil prices in general.
They do. So a couple of factors here is one is the price of methanol and one's view on that. And we think the price for methanol improves going forward. So that's one reason that we like the stock at this point. The other is kind of a plethora of other things. Nat gas is the feeder stock into methanol. So if nat gas prices ease, and of course I know we're dealing with what's happening in Europe right now, what's happening to the the global price of nat gas, especially as we go into the winter. But our view again is that we probably see some easement there, which would be beneficial for Methanex. And then thirdly, Andy, would be things like transportation costs. So Methanex is significantly impacted by rising transportation costs to transport the product. So in an environment where fuel prices or shipping fuel prices are high, that tends to be not such a good thing for the bottom line. We're seeing the opposite now, right? So I think now we start to look at a constructive case for costs for Methanex. So we came into Methanex. We had Methanex in the portfolio many years ago. Now we're coming back into the stock and starting to add to it.
That's interesting. And just, Andrew, remind us your take on oil. Do you think oil will hold at roughly current levels, or do you see it going above $100? I know you've touched on this already.
Well, I think it could go back above $100 a barrel. I mean, at the end of the day, we're not we're not oil bulls, Andy. We don't think oil's going to $200 or $300 a barrel. But these levels would suggest to me that we've probably seen a disproportionate downdraft in the price of oil, premised on recession that may not happen. And in fact, if we look at some of the other indicators coming out, suggests that we probably could, and I know viewers are going to be shocked, that you might actually get a soft landing out of this. And I just love the debate between analysts and economists over how this is not going to happen. Go back to 1994 when we had massive rate hikes at the Bank of Canada and the Fed, and guess what we got back then? A soft landing. So I think if we get the same scenario here, that's actually constructive for the price of oil going forward.